Hi, I'm Noah Dreyfus from Dreyfus Capital Management, and today we're going to be discussing the nature of a bond and the risks associated with investing in bonds, and hopefully we'll get some clarity on this issue. A common topic brought up by clients is they think about bonds similar to the way that they think about stocks, meaning they go out and purchase a stock and they have a fractional ownership share in that company when they own that stock. A bond is not a stock. It is not an ownership in an asset. More, it is a loan that you make to an institution. So think about it this way. Let's say a friend approaches you and asks to borrow money. What are the common things you're going to ask that friend when they try to borrow that money? So when your friend tries to borrow money, the three main questions you're probably going to try to ask them is, what is your ability to pay me back first? Second, when are you going to pay me back? And third, you may or may not ask this depending on the friend, but how much interest are you going to pay me for the time that I don't have the money I lend you in my pocket? So same thing with a bond. Bonds carry a credit rating, which is a measure of the ability for the institution that you lend money to pay you back. It has a maturity date for when that institution is required to pay you back, and carries an interest rate, or the amount of money you'll receive in compensation for not having that money in your own pocket and lending it to that institution for the duration or the amount of time that you lend money to that institution. So when we're evaluating the credit rating of a bond, or the ability for that institution to pay you back the money you lend it to them, there are a couple different considerations. So the first thing is that there are three credit rating agencies for bonds: Standard & Poor's, Moody's, and Fitch. And they're all going to issue their own rating on every institution that's issuing a bond in the market. There are also two types of bonds: investment grade and non-investment grade, or what's commonly known as junk bonds. So with investment grade bonds, they have reached a minimum credit rating to be considered investable by one of the above agencies, either Standard & Poor's, Moody's, or Fitch. And by relying on that rating, they are saying that these rating agencies are saying that these bonds are not at risk of default. And in their view, those institutions can pay back the money that you lend to them. In contrast, junk bonds, when you're investing in junk bonds or bonds with ratings less than the minimum for investment grade, you are taking upon yourself the risk or the due diligence to make sure that the institution that you're lending money to can pay you back. And that's a big risk with junk bonds. Now, what happens, whether it's a junk bond or an investment grade bond, if the institution can't actually pay you back, or they go out of business for some reason, they don't have the cash? Well, what happens is that institution would go ahead and file bankruptcy. They would go before a bankruptcy judge. The bankruptcy judge would decide, okay, these are the assets that this institution owns. If we sell them off, what kind of value can we get off of them? And then from those asset values, from the sales proceeds of those assets, they go ahead and pay back as much of the bondholders as allowed by the assets backing the institution. So now that we've covered credit risk, it's important to look at some other factors when it comes to bonds, as credit risk is not the only factor you're going to evaluate when you're thinking about purchasing a bond. The next factor in evaluating whether to invest in a bond or not is what's called duration risk. So duration risk is how long am I lending out my money for? Meaning, right now it is May of 2023. The longer I lend out my money for, the bigger the risk there is to me in my financial journey, in my investment journey. For a couple different reasons. First of all, the institution that I could lend money to might be secure and safe today and for the next couple of years, but who knows if 10 years out they'll still be in business, if they'll have filed bankruptcy by then, and then my money is at risk at a higher level when I'm lending out for 10 years than when I'm lending out for 1 year. Second risk and duration risk is really what's called opportunity cost value. So if I'm tying my money up for longer, I expect to be paid more in interest because I will have more opportunities come up over the next 10 years to invest than I will over the next necessarily 3 months, 6 months, 1 year. And so because I have more opportunities to invest in other things and I'm tying my money up for longer, therefore the risk that I'm going to miss an opportunity out there for other investments is higher. Another factor with duration risk is really what leads us into what's called market risk, or the risk of interest rates rising or falling over the period of time that I have my money lent out for. So let's take a second and look at a couple examples, see how this plays out. So for our example, Fred in 2021 retires and goes ahead and takes $100,000 and he buys 100 bonds from the U.S. Treasury, as bonds are typically sold in $1,000 increments. So if he wants to buy 100,000 bonds, that would be 100 bonds for $1,000 apiece. And he buys them with a maturity date of May of 2027. And an interest rate, or what's called a coupon rate, of 2%. So this means that every year that Fred holds these bonds, the bonds will pay $2,000 in interest, which is 2%, and a total interest amount, or a total yield over the life of the bond of 6 years, of $12,000 in interest. Now, in May of 2023, Fred develops a health issue and needs $100,000 to cover his medical expenses. But at the same time, in May of 2023, bonds that are maturing in 2027 have an interest rate of 4% because the Federal Reserve for the past 2 years has been hiking the interest rates. The interest rates now on the market are 4%, or double what Fred received in May of 2021. So the main issue Fred is experiencing is that he needs to sell his treasury bonds, but his treasury bonds only pay 2%, and new treasury bonds maturing at the same time from the same institution are paying 4% in interest in the market. Any buyer of Fred's bonds is going to expect to be compensated the difference in interest between Fred's bonds and the new market bonds. So remember, $100,000 in U.S. Treasury bonds paying 2% pays $2,000 in annual interest, or $12,000 over 6 years. However, the same amount of bonds, $100,000 in bonds at 4%, pays $4,000 in annual interest, or $24,000 over 6 years. So in this situation, there is 4 years left until Fred's bonds mature. And over the life of those 4 years, each year is going to have $2,000 in interest, equaling $8,000 in interest from now in May of 2023 through May of 2027. a total of 4 years. So if a buyer, let's say Jim, were to buy new treasury bonds on the market for the same period of time until May of 2027, he's going to go ahead and receive $16,000 in interest through the end of that period, because interest rates now are 4% and not 2%. So for every year that Jim were to invest his $100,000 lending to the U.S. Treasury and holding that bond, he would get 4% now. He's going to get 4% per year. We take that $4,000, which is $4,000. We take that, times it by 4, and we get $16,000 through May of 2027. So if Fred wants to sell his bonds to Jim to cover his medical expenses, what he's going to have to do is sell the 100,000 quantity of bonds that he originally paid $100,000 for. And he's going to have to discount that by $8,000, because remember, there's 4 years left until the bond matures. If Jim were to buy new bonds, he would get $16,000 in interest. Fred's bonds only pay $8,000 in interest until the maturity. So he needs to discount the $100,000 by $8,000 and sell those bonds for $92,000. Which they still pay $8,000 in interest over the life of the loan. And then Jim gets a fair deal because he's getting $16,000 off of the 100,000. In total, he gets a 4% interest rate. But what that means for Fred is that even though he took the $4,000 from year 1 and year 2 in interest, he exits the sale of the bond with $92,000. So if you take $92,000 and you add that to the $4,000, he's going to end up in total with $96,000, or $4,000 less than he paid for the bonds, a roughly 4% loss. Okay, I hope this video has been helpful for you. If you like the content in this video, please like, share, and subscribe. And I will see you in the next content video. Also, if you need clarity in your investment journey and are looking to speak with an advisor, please follow the link below to my website, schedule an appointment through the contacts form, and I look forward to speaking with you soon. Have a great day.